You're sitting there doing mental math. You see a $500,000 house online, and you don't even flinch anymore. Because somehow, that's just what houses cost now. $500,000. For something the listing describes as a cozy starter home, with one bathroom, and a kitchen that was last updated in 2003. And you're sitting there wondering, did salaries secretly double while I wasn't paying attention? Did I miss some memo? Or did the housing market completely detach from reality? Here's the answer nobody wants to say out loud. It's not you. It's the math. And the math is brutal. Today, we're not asking whether a bank will approve you for this house. Banks approve people for things they can barely survive every single day. The real question is, who can actually afford a $500,000 house without turning their entire life into a financial stress experiment? Because there's a massive difference between qualifying for a mortgage. The old rule was simple. Put 20% down. On a $500,000 house, that's $100,000 cash. Before you touch a single piece of furniture. Before moving trucks. Before anything. Let that sit for a second. $100,000. The median American savings account has less than $10,000 in it. So most people aren't a little short on the down payment. They're about $90,000 short. Maybe you think, I'll save it. Okay, let's say you earn $90,000 a year and you're disciplined, incredibly disciplined. You save 10% of your income every year, which most people don't do. That's $9,000 a year. At that rate, it takes over 11 years to save the down payment. 11 years. And that assumes prices don't rise, which they historically do, faster than you're saving. So most people skip the 20%. They put 5 or 10% down instead. And the moment you do that, the bank has a gift for you. It's called PMI, Private Mortgage Insurance. A monthly fee you pay because you weren't wealthy enough to put more down. It protects the bank, not you. Never you. That's usually an extra Let's say you put 10% down. That's $50,000 up front. You now have a $450,000 loan. At today's interest rates, somewhere between 6 and 7%, your monthly principal and interest payment lands around $2,800. That's just the loan. That's not the house. That's the debt on the house. Now we add reality. Property taxes? Around $500 a month, depending on your state. Homeowners insurance? Around $300. Maintenance? The standard rule is 1% of the home's value per year. On a $500,000 house, that's $5,000 a year, or about $417 a month. And that's not if something goes wrong. That's just normal upkeep. PMI? Another $300. Add it up. $2,800 mortgage, $500 taxes, $300 insurance, $417 maintenance. Need to earn around $185,000 a year. Even need to earn around $185,000 a year. Even if you use the more aggressive number, the 43% debt-to-income ratio that banks sometimes allow, you still need about $150,000 a year. The median household income in America is around $75,000. That's less than half of what this math requires. Which means this isn't a niche problem. This isn't a some people problem. For the majority of American households, a $500,000 house is mathematically out of reach. Not because of bad decisions, but because the numbers simply don't work. Let's be generous. Let's imagine a dual-income household pulling in $160,000 combined. That sounds solid. That sounds like they've made it. After taxes, retirement contributions, and deductions, they're taking home roughly $9,500 a month. Subtract $4,300 for housing. They have $5,200 left. Now, let's live a normal life. 2 car payments, $800. Car insurance, $250. Gas, $300. Student loans, $600. Health insurance premiums, $400. Groceries, $800. Utilities and internet, $450. They're down to about $1,600. From that, they still need to cover clothing, unexpected medical bills, car repairs, a real emergency fund, retirement beyond the bare minimum, and anything resembling a social life or a vacation. This household is spending nearly half their take-home pay just on the roof over their heads. And they're not reckless. They're not frivolous. They're just trying to live in what the market calls normal. This is where the numbers stop being abstract. It feels like scanning your bank account before you add something to your grocery cart. It feels like hoping nothing breaks this month. Genuinely hoping. Like a prayer. It feels like you're one job loss, one medical bill, one broken furnace away from a real crisis. You own a house on paper, but mentally, emotionally, the house owns you. Every financial decision filters through a single question. Can we still make the mortgage? That's not wealth. That's not security. That's a very expensive kind of trapped. Here's the part nobody in the transaction will tell you. The market doesn't care if you're comfortable. Sellers price based on what other homes sold for. not what's fair to you. Banks approve loans based on default risk, not your peace of mind or your career stability. Real estate agents earn their commission when the deal closes, not when you thrive in the home 5 years later. Insurance companies, title companies, everyone collects, regardless of whether this was the right move for you. Nobody in that transaction profits when you walk away. The system is perfectly designed to get you into the house. What happens after closing? That's your problem. Let's zoom out for a second, because this isn't some random bad luck. Home prices have risen dramatically faster than wages for decades. In the 1970s and 80s, the average home cost roughly 3 times the average annual income. That ratio made mortgages manageable. Today, that ratio, in many markets, is 6, 7, even 8 times income. The houses didn't get twice as good. The land didn't get twice as valuable in any fundamental way. What happened is a combination of low interest rates for years, flooding demand, institutional investors buying up inventory, zoning laws blocking new supply, and short-term rental culture pulling homes out of the market. The ratio is broken, and pretending it isn't, or blaming people for not saving harder, doesn't fix anything. So what do you actually do with this? Because just don't buy a house isn't really an answer. First, if you're renting and feeling embarrassed about it, stop. In many markets right now, renting is the financially rational choice. You're not behind. You're paying for flexibility and protection from a broken market. Second, look at the total cost honestly before you fall in love with a listing. Not just the mortgage, every dollar. Run the full number. Third, if you do buy below your approval limit. The bank will approve you for more than you should spend. That's not a green light. That's a ceiling, not a target. And fourth, time in the market matters, but not at any cost. Buying a house you can't sustainably afford doesn't build wealth. It destroys it. Slowly, stressfully, one stretched month at a time. There's no prize for being house poor. No trophy for pushing yourself to the absolute financial edge for a zip code. The real question isn't, can I get approved? The real question is, will this improve my life? Because real wealth isn't equity on paper in a house you're struggling to keep. Real wealth is margin, flexibility, the ability to absorb a bad month without a crisis. If the math doesn't work for you right now, that's not failure, that's clarity. Sometimes the smartest move isn't stretching to play a game that's rigged against you. It's recognizing that, clearly, without shame, and then making a different choice.